Hey guys, this is Durden from the Lifinity Discord. Today I'm going to be walking you through our pools page on our app, and also we're going to be looking at how to deposit liquidity on our platform. We recently just opened deposits for people who have the Igniter LP Pass NFTs, so we'll be covering that as well. All right, let's get started. So first thing, starting from the left, we have our asset pairs. We have 5 right now, and we'll be adding more gradually. You can see that our stable pairs are labeled as testing. We are currently trying some new strategies with our stable pools. So yeah, until we finish testing, you will not be able to deposit in them, but when we think they are ready, we will open those up to depositors as well. All right, in the next column, we have total liquidity. This is pretty straightforward. It's just the total amount of assets that have been deposited in each pool. And next we have a column called target liquidity. This one is unique to Lifinity. The target liquidity is essentially the highest liquidity point where we maximize the amount of trading fees earned per LP token. And if the liquidity goes beyond the target liquidity, that's when we estimate the trading fees per LP token will start to decrease. Now, the current numbers are basically placeholders. It's not like we carefully calculated them. And in fact, you can't really calculate a target liquidity. You have to find it through trial and error. And so we'll be gradually increasing the target liquidities until we notice that additional liquidity is no longer increasing the trading fees per LP token. And so that'll be a gradual process. And our pools have a thing called dynamic fees for LPs. And as the liquidity of a pool approaches the target liquidity, the amount of trading fees that LPs receive will gradually decrease, basically signaling to them that we don't need their liquidity as much anymore. Now, this is something we haven't implemented, and we're going to be doing that after our IDO. So you can ignore that for now. For now, these target liquidities basically serve as caps to the pool. So for example, with a Sol USDC pool, we have 1 million target liquidity, and then we already have more than that. We have about 1.3 million of liquidity in this pool. This is because when we first deposited assets in this pool, it was at 1 million, but then it generated trading fees and market making profit, and the value of Sol appreciated. So now it has much more than just 1 million. And so it grew beyond that 1 million. We just haven't withdrawn it. And yeah, but all that to say, users will not be able to deposit into this pool because it's already reached its target liquidity. But take Sol USDT, for example, you will be able to deposit because it has less than the target liquidity. And similarly for BTC USDC. All right, moving on, we have the concentration column. So concentration is basically if you want to provide the same amount of liquidity that we do on a standard constant product AMM, it tells you how much more liquidity than we have you would need on that standard constant product AMM. So for example, right here, the Sol USDC has 1.3 million of liquidity. If you wanted to provide the same level of liquidity on a constant product AMM, you would need 100 times that. So about 130 million of liquidity to provide the same level of liquidity. So this number basically just tells you how efficient we are. And you'll notice that the concentration of our stable pools is much higher than our volatile pools. And that's because the assets in stable pools, as their name implies, are pegged to the same thing, in this case to the US dollar. So there's very little price movement between the two because they are pegged. And so we can use much higher concentration safely. Normally, when you increase the concentration, that will increase the risk of impermanent loss. But because the assets are pegged to the same thing, that significantly decreases the risk of impermanent loss, and that's why we are able to use much more concentration. All right, moving on, we have the 24-hour volume and the 7-day volume. This volume includes both trades routed to us from Jupyter and also all the trades that are done on our app natively. All right, next let's talk about net APR. So usually on other dexes, this number is called just APR or trading fees, depending on the dex. We're calling it net APR because we include not just trading fees, but also what we're calling market making profit. This is simply the total profit and loss from market making. So on other exchanges, in particular constant product AMMs, and also Uniswap v3 style protocols, the result of market making will always be a loss. It's impossible by design to make money from market making on those kinds of protocols. And that's what results in impermanent loss. Impermanent loss is also the total profit and loss from market making. It's just that there never is any profit. It's always loss, and that's why it's called impermanent loss. But on our DEX, because we use an oracle, we do have the potential to make a net profit from market making. And that's why we're calling it market making profit. And this number can be positive or it can be negative. So let's address the elephant in the room. Our Sol USDC pool has a very high APR, almost 100%, and most of it is coming from market making profit. On the other hand, we have the Sol USDT pool, and it currently has a negative APR. Now, this might seem very strange to people because Sol USDC and Sol USDT seems like they should essentially be the same. The only difference is the USDT and USDC, and those are different assets, but they're pegged to the same thing, the US dollar. So shouldn't the trading activity and as a result the profits be exactly the same? And that's a natural question to ask. So let's take it step by step. So first of all, the trading fees. What contributes to trading fees? Well, trading fees is simply a function of total volume. So the more volume you have, the more trading fees you have. And if you've traded on DEXs before, you might have noticed that you get better prices with USDC than with USDT in general. This is simply because USDC is the more commonly used token. So what I'm getting at is that you're going to have more trading volume on the Sol USDC pair than you are on the Sol USDT pair. I'm not sure what the exact difference is, but just looking at the trading fees, you can see that the Sol USDC pair has almost double the trading fees of the Sol USDT pair. So perhaps it's something like double. And then moving on to market making profit. So first of all, it's positive with the Sol USDC, and with the Sol USDT, it is negative. So how is this happening? What contributes to profit and loss in market making? So one thing we have to think about is the day that you deposited. So with the Sol USDC, this pool we started on February 17th. On the other hand, the Sol USDT pool was started on March 16th, so nearly a month later. How is that significant? Well, let's take a look at the price chart of Sol so I can explain it a bit. So starting with Sol USDT, we started on March 16th, so right here on this candle. As you can see, since that time, the price action for Sol has been basically up only. It went all the way from something around $85 all the way to $126. And basically very little chop in between, pretty much a straight line up. Now, if you're familiar with how impermanent loss works, you should know that this is not good for you, because as the price goes up, you realize, or your pool becomes imbalanced. It starts out with a 50-50 balance, but as the value of SOL increases, you have more SOL than you do USDC. So then you start to sell some SOL. So for example, you go from 85 to 100, and you're like, I have a lot of SOL, so sell some here. Then it goes to 110, and once again, you're like, the value of SOL increased again, so I need to rebalance to 50-50. You sell some more. And by the time you get to 126, you've already sold SOL twice here and here. So the way to think about it is you would have been better off if you didn't sell here and here, and if you just held all the way till here and then sold, for example. But you sold early, and therefore you experience some loss. So this is basically how impermanent loss works. And all right, now let's look at the other one, SOL USDC. This one, the pool started on March 17th, which is, let's see, right here. So around $97. And you can see that the price action, first it went down a bit, and then it returned to 97. Then it went down again and returned to 97. And then after that, it went to 126. So first of all, the major difference, or actually, there's 2 points of difference. One is that we started closer to the end price, the current price, which is $126. So that means if we just look at it from our starting point to the end point, we have less impermanent loss compared to the SOL USDT pool, which started with $87. But the other factor is that in the meantime, the time that it took to get all the way here, we had much more time to generate market making profit. So for example, this is basically what happened. I'm doing some simplification here, but for illustrative purposes. The price of SOL USDC started here. Then it decreased all the way to 85. And when price reached here, we bought some SOL because now we have more USDC than SOL. And so we bought SOL all the way down here, and then we returned to our starting price. And because we bought SOL down here, now we have more SOL than 50% of the pool. So we sell it here. So we bought SOL at 85, and then we sell it at around 100. And that gives us a profit. And then we see price goes down again, goes down all the way to 80. And so down here, we once again buy SOL because we have less SOL than we started with. And then when we get back to 100, we sell again. So we bought SOL at 80 and we sold it at 100, again, making a profit. And then from 100 to 126, we experience a little bit of impermanent loss. And so there are your 2 stories of how these numbers came to be, basically. And you can see that although SOL USDC also experienced, quote, impermanent loss, or in other words, there were market-making trades that it made that resulted in a loss. If you look at all the trades together, the vast majority of them generated a profit, and that's why in total it's generating so much profit. And that was largely due to the fact that it had more time to generate that market-making profit, and it had some favorable movements here where it went down, then back up, and then down and back up, which is really ideal for us to generate market-making profit. Whereas for the SOL USDT pool, it just had up, 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 up. So it had very little opportunity to generate that market-making profit. Now, that said, even though we did generate a negative market-making profit, it is very important to note that we did much, much better than constant product AMMs would have performed. And this is basically what the next column is expressing. It's called CA, which stands for competitive advantage. So this is the difference between our market making profit and the impermanent loss experienced on constant product pools if the assets were deposited on the same day as whenever these were deposited. So basically, it's just the hypothetical of, okay, if our pools were a constant product AMM, how much better did we do than that? And so this is what this number tells you. So what this is saying is, if our Sol USDT pool was a constant product pool, we would have done 27% worse than what we actually did. So in other words, we would have had about negative 31% instead of negative 4.5%. So we're doing way, way better than constant product AMMs. And if you read through our articles, you'll notice that we say our protocol has is able to reduce and sometimes reverse impermanent loss. And until now, we've mostly only had the Sol USDC pool, and it has basically always generated a positive market-making profit. And we haven't seen any pools generate a negative market-making profit yet. So this is our first case with the Sol USDT. Nevertheless, we were able to reduce the impermanent loss by a lot, by 27%. And like similarly, you can look at it for the Sol USDC pool. This generates an extra 63% of revenue compared to a constant product pool. So if this were a constant product pool, its APR would be only 35%. So yeah, I think this has caused a lot of confusion among some people, confused as to why the APR is negative, because on other dexes, they've never seen a negative APR. And so this has been confusing to them. Now, just to briefly explain why you've never seen a negative APR on other dexes is because other dexes do not show you the impermanent loss. The reason they don't show you, I presume, is because it would mean fewer people would provide liquidity on their platform. They basically only want to show you the positive side of their DEX. So they show you the trading fees and they show you their liquidity mining rewards, but they do not show you their market making profit, or in other words, their impermanent loss. But we do show you whether it's positive or negative, and we also show you what you would be getting on other platforms that have constant product pools. Or if they are Uniswap v3 style pools, then their impermanent loss is probably worse than on a constant product pool. Because like I mentioned earlier, concentration means you can earn more trading fees, but it also increases the risk of impermanent loss. So yeah, other platforms just do not show you these numbers, but we want to be transparent. So we show you the impermanent loss, or our market making profit rather, because most often it is going to be positive. We believe it is a rare case when it is negative. For example, the Sol USDT pool, it's negative right now precisely because of these negative market conditions. But with time, as you've seen with the Sol USDC pool, where it had time to generate market making profit, we expect that the Sol USDT pool will also see similar results, where the market will eventually go down sometime, and that will create an opportunity for us to generate that market making profit. Okay, moving on, we have the refresh button up here. This will automatically refresh every 1 minute, or if you click it, it'll refresh all the data for you. And we have the settings where you can choose your slippage tolerance. Usually 0.1% is good enough, but you can make it higher or lower here if you want. And when you make a transaction, it'll show you in the bottom left a link to your transaction, and you can choose which explorer you'd like to view your transaction in. I recommend SolScan. All right, so now that we've gotten those things out of the way, let's try depositing into one of the pools. Like we said earlier, Sol USDC already is past the target liquidity, so we will not be able to deposit there. So let's try Sol USDT. All right, we're shown this interface where we can input the amount of Sol and USDT that we want to deposit. So for example, if I type 1 USDT here, it'll auto-populate the Sol field. Now what it's doing here is, down here you can see that there's the pool balance. This shows you how much of each asset we have. So we have 48.7% Sol in our pool and 51.3% USDT in our pool. So this $1 of USDT will account for 51.3% of what I'm depositing, and this amount of Sol will account for 48.7% of what I'm depositing. And if I want to deposit the maximum I can just click the max button, and you'll notice that although my total balance is more than 3 Sol, when I click max, it only shows less than 1 Sol. The reason for that is I have more Sol than I do USDT. So I don't have enough USDT to match all the Sol that I have. So even if I click max for the Sol, it'll just choose the lesser of the two assets that I have, which in this case is USDT. So choose the maximum of USDT. This is all the assets that I have in my wallet. And then it matches that with the balanced amount according to the pool balance of Sol. All right, so let's say I want to deposit 100 USDT. And just to run through these numbers, we've already covered total liquidity and target liquidity and the pool balance. We choose our slippage tolerance earlier in the settings. It shows you the number of LP tokens you will receive. And finally, it shows you the pool share, the percent of the pool that you will own after supplying this liquidity. All right, so let's click on supply the liquidity, and it says that it's making the transaction. In the right over here, I'm approving the transaction in my Phantom wallet. And now the transaction has been sent and it's being processed. If you click the here, it'll open your transaction in the Explorer that you chose earlier. Looks like my transaction has failed. The slippage limit has been reached. So that probably means that the pool balance changed while I was talking. So if that happens, you just refresh the data, go back here, input 100 again, and then supply liquidity. And should be good this time, probably. But you can see that the pool balance indeed has changed since we last checked it. All right, and this time the transaction did confirm. So now we have some liquidity on our DEX. Awesome. So let's close this window, hit refresh. And now we see that there's a withdraw button because we have some LP tokens. So let's click on that, see this interface, shows you your total amount of LP tokens. You can click max if you want to withdraw it all. Now you'll notice that the amount of USDT that I'll receive is slightly less than 100, the amount that I deposited. Now the reason for this is because in the meantime, trading has already taken place. So the pool balance has slightly changed from when I deposited. That's why there's slightly less USDT, but slightly more Sol. Now, this I want to bring up a point in relation to this. It's generally not a good idea to withdraw your assets soon after you've deposited them. And the reason for this is the shorter amount of time that you have deposited, the less amount of time you have to generate trading fees and also market making profit. So this is kind of related to what we saw with the Sol USDC and Sol USDT, where Sol USDC had enough time to generate market making profit, particularly because the market wasn't up only. whereas that was not the case for Sol USDT, and so it experienced much more impermanent loss. And this is true also on very short timescales. That was on the scale of weeks, but even on the scale of minutes, if you deposit for, say, just 1 minute and then you withdraw, you're generally gonna lose. Although the amount you lose will be a tiny amount, it'll nevertheless be a loss. And the reason for that is because in very small time frames, the price movement tends to be unidirectional. Or in other words, it just tends to go in one direction. Ideally, we like it when price goes one direction and then goes back to where you started. That's the ideal case for generating as much market making profit as possible. But yeah, the shorter the time scale that you do it, the smaller the chance that that's going to happen. In the extreme case, say you only do one trade, well, then it's impossible for price to go one direction and go back because it can only go one direction, and that's the end of your one trade. You need a second trade to bring it back to the original price. And so if you deposit, a single trade is made against the pool, and then you withdraw, you're guaranteed to experience impermanent loss. You will generate some trading fees from that single trade, but generally the trading fees from a single trade will be less than the impermanent loss that it creates. And so basically you need a bunch of trades that will cancel out the price movements going up and down and up and down. And in the meantime, generate a bunch of trading fees for you. That is basically how you make money from market making. And that simply requires time. So all that to say, we do not recommend depositing and withdrawing after a very short period of time. If you're going to deposit liquidity on our platform, we encourage you to have a medium to long-term outlook. In the meantime, you can see that the net APR for the Sol USDT pool has returned to being positive. So this once again reinforces the idea that we shouldn't really thinking about APR on short time frames because there's going to be a lot of fluctuation in short time periods. All right, well, that's about it for this tutorial. Thanks for listening. Lifinity is still in beta and is testing. So as with any DeFi protocol, please use at your own risk. And if you have any questions, please join us in our Discord. We'll be happy to answer all of them. And if you have any ideas for how we can improve our platform, or if you find any bugs, for example, please let us know there. And yeah, hope you enjoy using the Lifinity DEX.